Shall we have a look? All right, so we had a group structure that looked like this. Left owns right, 80%, right owns center, 80%. The dates of those transactions were at the same time, isn't it? So you could have seen it as 2, or you could have seen it as 1, and I think you would have got the exact same answer. I saw it as 2. It's just easier to do 2 than to do 1. So I did 2 on acquisition transactions. The first one, left bought right, share capital 150, retained earnings 1500, 20% NCI. They told you NCI was at face value. 80% is what we bought, 1320. We paid 1800, goodwill 480. Yeah. Then I did the bottom. Right bought center, share capital 50, retained earnings 1200, land 600, deferred tax 111, 888. Always look at the question, they will tell you what to use for deferred tax. I've seen sometimes they say 66.66. Sometimes they say use an effective rate of 18.4, which is all rounding, hey. Sometimes it's 66.67, sometimes it's 66.6, which is the one they've asked you to use here, 66.6. So you get deferred tax 111, 888, and you get a value of 1732112, of which 20% is NCI, and we then bought 1390490. We paid 1600, goodwill of 209510. So this is the goodwill that we have, the 209510. But remember, we have to split it, isn't it, into the NCI. We have to give some to that other NCI, the extra piece. So I split it 80-20, and I give the parent up at the top, left. I give left 167,608 plus the 480 that they had when they bought right, and you add those two together and you get goodwill of 647,608. That goodwill was impaired by 200, so if you look on the statement of financial position, you'll see a goodwill there of that number. Sorry, jeepers, I have to go back forever. 647,608 less the 200, 447,608. Yeah, and that they don't say how many marks each thing is worth, but that would be worth like a chunk, isn't it? A chunk of marks, that number. Especially if they didn't ask you to do journals or anything like that. Okay, so that's my initial calcs, the calc for goodwill. So remember the goodwill, it's partial goodwill method. I only want to reflect the goodwill of left. So left has goodwill, which is when they bought R, which is 480. And then left has goodwill, but it's only the 80% that they own of R, which is the 80% of the 209,510, 167,608. The other 20% goes to NCI. It's R's NCI, isn't it? This is the NCI of R. Up here, this is R's NCI. And down here, this is center's NCI, if we were to look at the NCIs. Yeah? So that's R, that's center, that's R. Okay, then we track retained earnings since, and we track current year. So I just put the numbers on to start. So I put on the 1500, the 1200, and the reval, the 488112, just in case there'd been a movement in the reval, but there was no movement in that reval. And then I put in the beginning of year retained earnings 4805 to 113 straight from the statements of financial position. And then statements of financial, well, they gave us a trial balance actually. And then I put on the profits, which they also gave us on the trial balance. Sometimes they're ugly and they give you like sales, cost of sales. You have to add numbers and numbers up. And you always have to add twice to check that you haven't made a mistake. But in this case, they gave you the profit 900 for left, for right, 720 for center. Remember, we're analyzing the reserves of the subsidiaries because I want to give NCI their share. So if I look at the numbers then, I've got a movement here of 3305 and a movement here of 912. Yeah. So at the top, I'm moving from 1500 to 4805. I've got 3305. 20% of that belongs to the non-controlling shareholder or the non-controlling interest of R, isn't it? Of R. So 661 of that belongs to R. And then at the bottom I have a movement of 913. And of that 913, 20% belongs to center's NCI and 20%, 80% belongs to right NCI. There's my 3 NCIs. I always need to have 3. So I have the NCI of R, the NCI of C, each getting their 20% of the company they own shares in. And then I have the extra piece. The extra piece is the middle NCI who gets an extra piece of the bottom. Yeah? So there's the extra piece. So top and extra pieces. So now at this stage, I checked the intercompany transactions, and the intercompany transactions, none of them were beginning of year. Because if they were, we would have had to go back and fix this number, hey, before you work out the 20%. So I put the numbers on, and then I do the intercompanies and check how they affect, and if they don't affect. So in this case, they didn't. So if we're looking at NCI beginning of year, which is a number that's in the statement of changes in equity, it's going to be this NCI, which is right, this NCI, which is center. This adjustment, which is the adjustment for goodwill, it's a minus, say, because goodwill, when we're adjusting it, remember, it's a minus. So that, which is R, this which is center, this is the piece of goodwill that belongs to R. Then there's this, which is the opening retained earnings pieces that belong to the 3. If you add up all those green numbers, add them up for me, you should get a number which is 1,625,400. So all the greens, if I was to add up all the greens, I get NCI beginning of year. I'm going to put it over here. NCI beginning of year, 1,625,400. And you mustn't forget, yeah, this is a minus, yeah? This is a minus. Let me put a bracket around it, a minus. Do you get? Okay. So NCI beginning of year, which is a number in the statement of financial position. So if you look here at the statement of financial position, it is here. There we go. 1,625,400. Do you see? They get the number from the analysis. It's just the 2 numbers from the analysis. But if you're not doing an analysis, if you've done calcs, yours is going to come from the calcs. What is NCI beginning of year? It's the NCIs on acquisition. If it's a vertical, there's the goodwill adjustment. And then it's the share of the since movement in reserves, in which in this case was just retained earnings. The 3 pieces, the R, the C, and the extra piece. And if you add that all up, 1,625,400. Okay. There's another number which is retained earnings beginning of year. Yeah. If you look at retained earnings beginning of year, you'll see that if you take the parents' retained earnings at beginning of year, what was the parents? 6 million. So if you take the parents' retained earnings at beginning of year, let's do that in a different color. Let's do it in pink, although it's not a very bright pink. I think I have to use the mouse there for some reason. I'm going to make it a bit thinner. Okay, so if I do that, retained earnings at beginning of year would be the parent, yeah, and the parent is, let me just extend down here a bit. Okay, so retained earnings beginning of year is the parent, which is the 6 million, yeah, which is left, and then it's the since acquisition that belongs to the, it's the since acquisition that belongs to the parent. So it's the 6 million. I start with that. And then I'm going to bring in the 3,305 and subtract the 661. Bring in the 913 and subtract the 182 and the 146, isn't it? And if I do that, plus all the adjustments, I get a number which should be the number that they have. The number they have is 9,228,320. 9,228,320. So let's just check if we get that. You do? Okay, so if you take the parent and then you bring in the movement for each of the subsidiaries and take off what's NCI, we get left with our number, isn't it? And these two numbers, NCI beginning and retained earnings beginning are worth a lot of marks if they ask you for a statement of changes in equity. Or if they ask you just for financial position, then it'll be the number at the end. But you'd still need to start there, isn't it, to get to the number at the end. Then the current year. In the current year, they gave us the two profits, 907.20. Then they gave us two intercompany transactions. One that was a downstream, left sold to center. Left has the profit. There's no NCIs sharing in left's profit, isn't it? Who are the shareholders of left? It's the shareholders of the group. So there's no intercompany adjustment to make for NCI for that. The adjustment there would be inventory, cost of sales, and that's it. No NCI impact. Yeah. When you work out that number, the profit's 100. Did you all get that? A profit of 100. Tax of 28, a net of 72. You would adjust your P&L, cost of sales 100, tax expense 28. You would adjust your financial position, inventory less by 100, deferred tax liability goes up by 28. Yeah, so that's those numbers. Then, no, it's a deferred tax asset, in fact, not a liability. It's an asset. Because left would have paid tax on that money, but we're only going to show the profit next year, so it's tax paid in advance. Okay, I was saying deferred tax liability and thinking that it's wrong. But that one doesn't impact our NCI, isn't it? You would do that entry, you would adjust cost of sales and inventory with that number, tax expense and deferred tax with that number, and that's it. Then the other intercompany transactions, center sold to right. The minute that there's stuff between center and right, you know that it's going to affect some shareholder, one shareholder or another, isn't it? And the fact that it's center that has the profit means that it will affect centers and right because of the extra bit. Yeah. So center made the profit. Do you agree? When they sold inventory to right, the profit was 25. Do you agree with that number? And the deferred tax on that was 7, leaving you with after-tax profit of 18. So what is that? What are we doing? Are we going to make inventory smaller? Profit smaller, isn't it? Profit smaller, inventory smaller. So I'm making profit smaller by the 18. So 720, which was the profit, is now going to become 702, which is the new profit I'm going to show. And that 702, then I'm going to give 20% to C, to C's NCI, and 20 of 80 to R's NCI. And at the top, the 900, I'm going to give straight to R's NCI. Yeah. So if I add those three numbers together now, and I just want to use a different color, I don't know, let's use blue. Although it's not a very bright blue, but anyway, let's use blue. If I want to make it a bit fatter. If I look at that number now, NCI's share of profit is the 180. Is the 180 over there, plus the 112, plus the 140. And if you add those three numbers, you'll see that's going to be the number that's sitting in the P&L. What does it add up to? 140? 432. So if we look at the P&L, and in the statement of changes in equity for that matter. So here in the statement of changes in equity, here's the 432, 720. Yeah. If we look in the P&L, right at the bottom will be the 432, 720 there. Okay. Then, you know that this here is the balancing figure, hey, the 1437. So this here then is the balancing figure, that one, to balance back, so that we've got the 2. And then this balancing figure lands up in the statement of changes in equity, the 1347 over here. Okay, so if we go back and have a look, then they asked you to prepare statements, isn't it? Statements. If we go back and look at statements, PPE, the only adjustment that they've made to PPE is that adjustment for the land. It was 600,000 Rand. It would be a straight 600. There were no other adjustments. So if we look at PPE, they say C6. I don't know why they did a calc for that, but let's find C6 quickly just to double check. Oh no, but it's not C6 because C6 is, what do they say? C9. Yeah. Okay, so here's PPE. I don't know why they do that. Okay. So basically what you'll see they've done in each of the cases is they've added left, right, center, and made the adjustment, yeah. And then for the other three, they've just done left, right, center, left, right, center. You could have just opened a bracket, put all those numbers in your bracket, and Bob's your uncle, isn't it? And then you don't have to write out these things that you're writing again and again, isn't it? Just wasting time. Okay, so that was the PPE. The goodwill we've looked at. Inventories, again, left, right, center, minus 100, minus 25, the two calcs we did, yeah. Receivables, left, right, center, and then the intercompany, which you'll see popping out at the bottom. Cash and cash equivalents, only two of the companies had cash and cash equivalents. Then when we look at share capital, it's just different, yeah. Retained earnings, if they don't ask you to do a statement of financial position, is a bracket with lots of numbers, do you agree? Or it's a calc, a column calc with just all the numbers coming out to that. But if they ask you to do a statement of financial position, you're just going to plug the number that's here, which is this number. Yeah, plug it back into the statement of financial position. If they ask you to do changes in equity, rather. Then NCI, once again, also just comes straight from there. Otherwise, it will also be a bracket with lots of numbers. So this is the two numbers that we saw. Is it? No, that isn't it. I want to actually undo because we didn't see those numbers. We don't do it that way. The number that we had, or where we would get our number, is from here. Yeah, do you agree? We had that number, we add them up. Okay. Or we would have a bracket with lots of numbers once again. What else is here? Equity, share capital, retained earnings, NCI. Deferred tax. Deferred tax is a big calc. Let's just have a look at it quickly, because deferred tax would have the deferred tax of the three companies, yeah, which is what they start with, left, right, center. Then don't forget the ONAC adjustments, isn't it? The ONAC adjustment would have had a deferred tax, the 111,888. And then on the unrealized profit, both of those are assets. I've paid tax in advance. It's profit that's been recognized in the companies. They've had to pay tax on it. From a group perspective, we're only going to recognize it next year, so it's tax paid in advance. It makes the numbers smaller. Be careful, if you work out the numbers correctly, but you put them in the wrong way, then you don't get the mark. Yeah, it goes the other way. Okay. What else is here? I think pretty much that's more or less it. Then they've got short-term borrowings, the trade and other payables with that adjustment for the 15, and a current tax payable. They have a P&L, which is the two profit numbers added for the year. NCI is your big calc, and then statement of changes in equity we've gone through. Okay, so you can see if you look at their calculations, hey, this is where their calculations start. So basically, almost a full page, because the statement of changes in equity is short at the top, isn't it? So almost a full page there. 1, 2, 3. Okay, this is comments. So maybe this one we can ignore. Just comments. Okay, so maybe another piece. So let's say it's still 2, 3. Okay, 3 whole pages of calcs, isn't it? It's really overkill. It's 3 pages of calcs to present 1 and a bit pages of solution. It doesn't make sense. Do you agree? It doesn't make sense. So wherever possible, you should try to minimize. And then here's the journal. So if you had decided to do journals, which some institutions teach journals as calcs, so they would have done journals instead of the analysis, but journals instead of the analysis also take time. Look how many journals it is, isn't it? You'll see when they do journals instead of the analysis, they have a column for NCI. Do you see it at the back there? And then what happens is that they put all the current year stuff, all the prior, they do it sort of chronologically, so that at some point they have a beginning of year total. Do you see? But really, it's another, journals is even worse to do than analysis, I think, because analysis, at least you can sort of not think about it and just push numbers. But journals, you have to think, to debit what, credit what. So, yeah, and some more journals, 2 whole pages of journals just about. Okay, so I prefer to show calcs. I agree, this is like a mess, isn't it? But you're not going to put it all on one page like that. And essentially, what this timeline is almost like what's on your analysis, but the other way, isn't it? Showing horizontal instead of vertical. But all your calcs are there, as much as you need, isn't it, to then show your workings. Okay, so vertical groups. Difficult? It's okay. Yeah. Why? You don't know. It's just hearing it again, perhaps. Yeah. But it's making sense, huh? It is making sense where the numbers are coming from, where they're going. Because I promise you, as you move through, like when you move to honors, intercompany transactions become more complicated. The things become more complicated. It's very important that you're able to have that big picture view, which is, what am I trying to do? Not how am I going to do it, but what am I trying to do? Because if you know that, you can figure out for yourself how you're going to get there. Do you agree? So we always must try and remember what it is that we're trying to do. What is retained earnings beginning? What is NCI? What are those principles that's got to flow through into my group numbers so that then when they flow through correctly? Sure, imagine giving that to somebody as a working, but you know, yours is going to be neater, right, in the exam. And then you're going to take these numbers to put in your brackets. And you could even, if you wanted to, instead of putting the 661 in a bracket, put 20% of 3305 in a bracket, because then it's clearer what that number is, isn't it? Okay. Questions? Nothing. All right. So next week then, so that's subsidiaries done. Then next week we're going to move on to associates. Yeah? We'll come back to subsidiaries when we do changes in control. But for a couple of weeks now we're going to do some other stuff, and then we'll come back to that again. All right.